Hello to everyone. Today I am here with Financial Risk Management Part 5. If you are interested to have more videos related to banking and finance related topics, please do subscribe my channel. In the previous lecture, we have discussed about Basel 1 and Basel 2. Today we are going to discuss about Basel 3 framework, strengthening the capital framework, providing the quality and consistent transparency of the capital base. It is one of the strengths, enhancing risk coverage, supplementing the risk-based capital requirement with a leverage ratio, reducing cross-cyclicality and promoting counter-cyclical buffer, addressing systematic risk and interconnectedness. Now, here I have defined what is pro-cyclicality as a manner in which the banking system interacts with the real economic to exacerbate the economic cycle, whereas economic quantity that is negatively correlate with the overall state of the economy is said to be counter-cyclicality. So they basically initiate to promote counter-cyclical buffer as a part of Basel III. Scope of Basel III. Basel III is initiated for encompassing a comprehensive set of reform measures to strengthen the regulation, supervision, and risk management of banking sector. The reform target both micro and macroeconomic improvement, bank level or microprudential regulations, which will help raise the resilience of individual banking institutions to periods of stress. Regulations that deal with the macroprudential system-wide risk that can build up across the banking sector, as well as the pro-cyclical implication of these risks over time. The main documents outlining Basel III International enhancement to Basel II framework. As I have already said that the weaknesses or the problematic areas which are addressed earlier should modify it in the upcoming document. So the problematic and the weaknesses related to Basel I and Basel II are addressed in Basel III. Revision to Basel II market risk framework, guideline for internal rating, calculation, principle of the sound liquidity risk management, international liquidity risk management framework, strengthening the resilience of the banking sector. So these areas are addressed in Basel III. Further, regulator consistent July 26, 2010 capital collaboration. It's addressed on September 12, 2010. Reform environment state of the Western industry post-crisis. The Western financial markets are showing the sign of both recovery and reminders of the crisis. Clearly, this system is still helpless and has not yet reached fully a state of resilience to the further volatility and sloppy economic growth. So sometimes like the crisis, COVID is one of the examples. Nobody having the prediction about any such diseases, and sometimes some crises related to the environment cannot forecast earlier. What's new in the Basel III? As per the new revision, the common capital required to increase by 2.5% from 2%, from 2% to 4.5%. So they basically try to more strengthen the capital requirement that work as a shock absorber for the banks in order to absorb the losses in the worst condition. Further, Tier 1 requirement increased by 2% from 4 to 6%. Overall, so over the period of 3 years, in 2013 to 15, thereafter, starting from 1st January 2016 and fully affected by 1st January 2019, additional capital conservation buffer equal to 2.5% added to a minimum capital of 4.5%. The capital instrument not qualify as common equity tier 1 capital or tier 2 capital and will be phased out over a 10-year period effective from 1st January 2013. These are the new changes in Basel III. Definition of capital. For the purpose of the calculation regulatory capital requirement, banks are required to classify their capital into 3 tiers as follows. First is the tier 1 capital. Tier 1 capital, also called as the core capital, shall compress of the highest quality capital element and will include fully paid up capital, capital deposited with central bank of the country, balance in share premium account. Sometimes you offer a share on the premium value. If its face value is say 100, it might be offered at 125. So 25 is the premium. Reserve for the issuance of bonus shares. General reserve at disclosed on the balance sheet. Unappropriate and unremitted profit, net of accumulated losses, if any. Now, what include in the tier 2 capital? General provision or the general reserve for the loan losses. These are normally against the consumer finance. Revaluation reserves, which are calculated on the assets. Exchange translation reserves, undisclosed reserve, subordinated debt. It's a part of capital 2. Now, what include in capital 3? What include in tier 3 capital? The tier 3 capital consisting of the short-term subordinated debt would be solely for the purpose of meeting a portion of the capital requirement for the market risk. And we know that the market risk is related mainly with the interest rate and the exchange rate. Tier 2 capital main feature. The main feature of tier 2 capital under the new regime is subordinated no agreement that legally or economically enhance the seniority of the claim, wise depositors and the general bank creditors allowed minimum original maturity of at least 5 years, amortized over the remaining 5 years of the maturity, no incentive to redeem, callable but not under restrictive circumstances, no acceleration right for payment, except in the bankruptcy or liquidation, no credit sensitive dividend feature, no direct or indirect funding through the bank. SEV structure fall under the same rules as for tier 1. Now, see you again with the upcoming video related to the Basel very soon. Thank you very much.